Hey, everybody. Welcome back to another episode of Rent Prep for Landlords. This is episode number 293. I am your host, Eric Worrell, and today we are going to be talking about 5 trends for 2020 with real estate. I read a pretty good article from Forbes.com, and then that one was actually titled 4 Trends for 2020, but there was another one that I wanted to talk about, which is something that I've noticed that's happening with a transition with the office and the typical engagement that employees are having with their work and how that's going to impact the rental market. All right, guys, we're going to get to that right after this.
1, 2, 3, 4.
Welcome to the Rent Prep for Landlords podcast. And now your host, Eric Worrell.
So I'm feeling good so far this year. About a week in, I have most of my resolutions still intact. Trying not to be too hard on myself this year, but figured I'd share with you guys how that's going. I know that's always top of mind this time of year, but one of the things that's interesting is I listened to a podcast from a guy called Roy Williams, Monday Morning Memo, and he was talking about why he actually doesn't put specific budgets and goals to things or timelines. He just has objectives. And he said that when you create a goal with a timeline, and this is very counterintuitive to a lot of things I've heard. I know I'm already going on a tangent for this week's episode, but he said when you create a timeline, it does hold your feet to the fire, but it also kind of gives you this anxiety and it makes you kind of hustle and maybe make decisions too quickly, as opposed to creating an objective and then working steadily at it every day. I like that idea because I know that I'm somebody who will, just create my own self-imposed goals. And then if I don't hit them, which a lot of times they're pretty high goals, then I'm disappointed. And this is something that I'm going to be kind of testing out and kind of playing with and just figuring out the right mix of it for myself in 2020 is creating objectives and then working every day to improve and get closer to those objectives. So just something I wanted to share that I picked up on a podcast I was listening to yesterday. So back to the tease of this episode, talked about the 5 trends for real estate investors in 2020. So I read an article by Ingo Windsor from Forbes.com, and his is called 4 Trends for Real Estate Investors in 2020. But reading the article kind of spurred a 5th trend that I wanted to kind of throw my own flavor on this. So one of the first things that he talks about is the greater concentration of demand. He said the U.S. economy is always changing, but the concentration of new jobs and therefore new demand for housing in a small number of big markets is something new. I didn't read that very well, but he said the concentration of new jobs in a small number of big markets is something new. So basically, they already know that most jobs are services or office jobs. What's changing is that businesses that provide these jobs need more and more of the support services that are most efficiently delivered in big markets. So what he says is that IT support, personnel support, office space, and most importantly, healthcare are more effective when they're concentrated. So businesses tend to cluster in markets where these services already exist, which in turn concentrates the services even more, making the markets even more attractive. He said that just 30 markets where 40% of the population lives received 60% of the new jobs created in the last 5 years. The other jobs were pretty much evenly spread around the country. So that's an interesting stat. Leave out the 30 markets. It's just saying that 40% of the population, where 40% of the population is, received 60% of the new jobs. So you could say it's almost like 50% more than what they should have received, right? Because 40% of the population should have received 40% of the new jobs. Well, they received 50% more than that, which brought them up to 60%. So that shows a pretty big discrepancy on where the new jobs are going, because they're just going into these 30 markets, which I'm going to go out on a limb and say Buffalo, New York is not one of them. I don't know where you are listening to this, but that's just a pretty safe bet on my part right there. So he said what this means for investors is that demand for housing in big markets almost certainly will continue to grow faster than builders can create more supply. In other words, prices will keep going up and so will rents. But you're talking about, the 30 biggest markets where this is happening. You're Austin, Texas, and places like this where they have these hubs that businesses are going to that are creating new jobs. The counterpoint to this, so I'll already get to the trend that kind of sparked in my mind when I read this, is one of the things that I follow is talking about remote work. So as you know, remote work is on the rise. People who maybe used to work in an office place and are now working from their home. There's 6 statistics on it about remote work in the U.S. that I got from flexjobs.com. This is by Bree Weller Reynolds, and this was July 29th, 2019, so pretty recent. And they said since 2005, remote work has grown 159%. Between 2016 and 2017, remote work grew 7.9%. Over the last 5 years, remote work growth is at 44%. And over the last 10 years, work remote has grown 91%. So 3.4% of the total U.S. population, workforce, I should say, are remote workers, which is up from 2.9% in 2015. Now, those numbers don't sound really large when you're talking about 2.9 to 3.4, but really, you're talking about, I don't know what the number is, but that's probably like a 20% lift or something like that just in a few years. So it said that 4.7 million people in the U.S. currently telecommute, up from 3.9 million in 2015. So a lot of these trends are towards remote work. And, in my situation, like I work in the office and I also work remotely, but I'm in the same town of RentPrep, Buffalo, New York, West Seneca area. But from what I've read is there's more people that are interested in establishing work. So they go to these high cost of living cities. So maybe they go to Silicon Valley because they want to create relationships and connections in a high cost of living city. And they show value to the employer. They show that they can get the job done. And then they decide they want to move to a medium or low cost of living city, but be able to retain that high salary. This is something that's happening more and more. I actually know a couple people that went to San Francisco, came back to Buffalo, and are making great incomes. They're making San Francisco level incomes, but living in Buffalo, which is a medium to low cost living city. So I bring this up because it's kind of counter to what that trend was mentioned in Forbes, where it's saying that the top 30 cities are where all the growth is going to be. I do think that remote work is going to kind of fly in the face of that a little bit, just because I think you're going to get more and more people that are making good income as the internet kind of opens up opportunities for everybody where you could live wherever you want. So I don't think it's just going to be about, living in those 30 cities that are the high cost of living cities with a lot going on. That's just my personal opinion. I haven't been asked to write for Forbes.com yet, but I do think that remote work is going to continue to grow, and that will be something that will have an interesting impact on your rental markets and real estate, as people then are really not affected by where they live. And if you're curious about that and you want to read more about that, I would suggest searching the term geo arbitrage. And basically what that means, arbitrage, you're trading one thing for a higher value of something else. Like you try to, it comes from economic markets usually, but in this particular case, you're talking about that example of going to San Francisco, getting a high paying job, leaving San Francisco. So you geo arbitrage into a lower cost of living city, but you keep that high paying income. It's really interesting because then that person can then, in that lower cost of living city, live like a king because they're making a great salary. Tim Ferriss popularized this in his the 4-Hour Work Week, where he talked about moving to an entire new country where the cost of living is extremely low and living like a king in that way. So it's just something to think about, but we will move on in the Forbes article. One of the things it talks about is slowing home prices. It's saying that this doesn't mean that prices can go up forever. Although demand for housing in big markets will be strong, prices of single-family homes have already peaked in San Francisco, Silicon Valley, Seattle, and are slowing in other markets as well. On average, U.S. home prices were up 5% last year, and he expects that they'll be up just 3% in 2020. So this can mean different things for different investors. One of the things is that if you want to save for investment in boom markets, consider apartments instead of single-family homes. The big question in markets that are peaking is what happens next. Boom markets usually end in a bust, and these might, but if the local economy keeps humming along, prices could just go sideways for years. The next trend that he's predicting is a bigger gap between owning and renting. So we've actually seen this. You hear a lot of people saying over the past few years that renting has become more popular for a couple of reasons, right? Millennials who grew up and got out of college and immediately hit a recession and are saddled with high debts with their student loans, have trouble buying. There's also the mindset of that person, right? They went through this recession. They've got this debt. Maybe they're like, you know what? I am not putting my money into the housing market and buying a house because that's not a safe bet. They just saw the crash in 2008. So That's part of it. But this is saying that the surge in home prices in recent years, especially in many of the big markets, puts a single-family home beyond the reach of more people. The ratio of prices to rents has always been high in markets like New York, San Fran, and also applies in Seattle, Portland, Miami, Nashville, Charlotte, Boston, Denver, Columbus, Austin. So this is good news for investors in rental property, but also means that it's difficult to just buy a single-family home and rent it out. The number of people who can afford the high rent is small. A better strategy is in these markets is to split a single-family home into several units. And even though that takes time and money, apartments are also a good idea, especially because rents will continue to rise even if home prices don't. So that's interesting because I've never heard that before about the strategy of just looking at these markets, buying single families and turning them into multiple units. I guess that's if you can't find a good multifamily in that area, or they're just priced way too high, you can go with that strategy. So the next trend mentioned by Ingo, the author of this article, is that smaller risks in smaller markets. In 2008, the crash exposed the weakness of the local economy in many smaller markets. So this is where unemployment soared and home prices fell. With a few exceptions, there hasn't been much of a rebound in these markets, but that also means that there's almost no remaining downside to rental property. You can't just invest blindly in these places. Some still have high unemployment. Some have just one big employer, maybe a military base, whose fortunes you must weigh. But in most cases, your economic risk is small, even if very little growth is taking place. Basically, if it's already bottomed out, you have less risk buying in an area that's closer to bottom because there's nowhere to go but up or sideways, right? So I think it's important to pay attention to trends because you want to know where things are going, where they're headed. So we know that we see this right now. If you go into, most malls in America, they don't look too hot, right? It's because more people are buying stuff online. The interesting thing, though, is in 2013, if somebody said, oh, e-commerce is going to be, the big thing, only about 5.8% of commerce in general happened online. But the projections right now for 2020 are about 12.4%. So again, that has nearly tripled since that time, and they're only going up. So if you can pay attention to these trends, especially ones that you think maybe have longevity, in my opinion, remote work, there's going to be obstacles. There's going to be things that are going to be hiccups along the way, but they're going to figure those things out. And I think that the best talent is going to be the person who gets the job in the future, not the person who's the best talent within 20 miles of the business. So I think that it's going to do the same thing as e-commerce has done. And you're just going to see a steady incline, and it's going to eat into overall commerce sales. I think with remote work, what you're going to see is that remote workers are going to eat into the labor force. And what that's going to do is it's not going to limit people to their geographic area anymore. People are going to have the luxury of living where they want and then working on their own time in more ways. So I truly believe in the next 5 years that that's going to have a big impact on housing markets and where people live. And maybe it means less people living in Buffalo because they don't want to deal with the winters anymore, but who knows? It'll be interesting to see how that plays out. All right, guys, thanks for humoring me as always and taking a listen to this podcast. Hope you got some little nuggets out of it. Thanks to Forbes.com and Ingo for writing that great article. And I look forward to catching up with you guys next week. All right, take care.